All right, today we're going to dive into a concept that is absolutely essential for any ETF investor: net asset value, or NAV. Seriously, understanding this is the key to knowing what your investment is truly worth. When you're looking at your screen and you see that ETF price ticking up and down, you probably think, okay, that's the whole story. But what if I told you there's another, more fundamental value kind of hiding just beneath the surface? So, what is an ETF really worth? To find out, we've got to look beyond that price flashing on your screen and find its sticker price. And in the world of finance, that has a very specific name. And that name is net asset value, or NAV for short. Think of it like this: if you could just snap your fingers and liquidate the entire ETF, sell off all its stocks and bonds, pay off any debts, the NAV is what you'd have left over for each and every share. It's the fund's official book value. The way they calculate it is actually surprisingly simple. You take the total value of all the stuff the fund owns, you subtract any liabilities, and then you just divide the result by how many shares are out there. The key thing to remember here is that this isn't some fluctuating guess. It's a precise, official calculation that's done once and only once at the end of each trading day. Okay, so on one hand, we have this official once-a-day book value. But on the other hand, we have the market price, which is changing every single second. So how do these two numbers relate to each other? Let's go back to that car analogy. The NAV is like the manufacturer's suggested retail price, the MSRP. It's the official calculated value. But the market price, that's the price on the shelf at the dealership, and it can change all the time based on plain old supply and demand. How many people are trying to buy that car on any given day? So, if demand for an ETF is really high, its market price can actually get pushed above its official NAV. This is what we call trading at a premium. You're basically paying a little extra because it's so popular, kind of like paying more for a hot concert ticket. And, of course, the opposite can happen. If there's a lot of selling pressure, the market price can dip below the NAV. In that case, the ETF is trading at a discount. You're essentially getting it on sale for less than what its underlying parts are worth. Now, you might be wondering, well, if these two prices can drift apart, what stops them from going completely wild? It turns out the market has a very clever, built-in mechanism to keep them hugged up pretty close to each other. And this mechanism is really, really effective. For the vast majority of popular liquid ETFs, the difference between the market price and the NAV is usually just pennies. It's all because of a process called arbitrage. The key players in this whole drama are a special group of large financial institutions. We're talking big banks and trading firms called authorized participants, or APs. And they have a unique ability that lets them correct any of these price differences. Okay, here's how it works. If an ETF starts trading at a premium, an AP can go and create a big block of new shares directly from the fund at the lower NAV, then immediately sell them on the open market for the higher price, and boom, they pocket the difference. All that selling pushes the market price back down. And if the ETF trades at a discount, they do the reverse, buy the cheap shares on the market and redeem them with the fund at the higher NAV. It's a really powerful, self-correcting system. So if this system works so well, why should you even care about NAV? Honestly, for most of the huge ETFs, you might not have to think about it too much. But for others, it's a critical piece of information. And the size of this gap between the price and the NAV can be really different. For a major, highly traded ETF, the premium or discount is usually tiny. We're talking fractions of a percent. But for a more specialized or illiquid fund, that gap can be a lot bigger. And that's when you really need to pay attention. So why does this matter to you? Well, checking the premium or discount is like a quick health check for an ETF. A consistently large gap can be a red flag. It might be signaling that there are liquidity issues or maybe even some stress in that particular market. This is most important for those less common, more specialized funds. So you see, the price is just the starting point. It's the NAV that reveals the real story underneath. The next time you're looking at an ETF, you'll have the tools to look past the market noise and ask the most important question: am I looking at its price, or am I seeing its true value?